Hello, welcome to Handout 17. In Handout 17, we're going to be returning to financial accounting. I bet you thought you were done with financial accounting, but you're never done with financial accounting in finance. As Warren Buffett says, financial accounting is the language of finance. So we're going to be returning a bit to financial accounting and learn how to project forward financial statements into the future. This is going to be useful for us in two ways. First of all, if we're doing ratio analysis, it's very helpful to have estimates of financial statements in forward periods to look at and create ratio analysis from those. So that'll help us to understand and predict the performance of companies we might be interested in buying the stock of or making a loan to. And the second reason that this is going to be helpful in general is when we are trying to value an entity using DCF methods, getting the NPV for the project, should we buy this company, hold it for a while, and sell it. Projecting forward financial statements is in general required to determine what free cash flows we think we can obtain from the entity while we're owning it. So that's why I'm torturing you with this stuff. Hopefully it won't be torturesome for most of you. And on that note, let's jump right in. Okay, so pro forma financial projections. So what are pro forma projections? All they are projections of our financial statements into future accounting periods. And why do we care? Why do we want to do this? You should always be questioning, why is he torturing us with this stuff? Well, there are a couple needs for financial projections, pro forma projections. The first is, remember we spent a lot of time on ratio analysis of financial statements. That was really helpful, except it was all based on history, right? So that limited our ability to predict what was going to happen in the future with an entity. And we can help overcome this problem by creating pro forma projections of financial statements into the future with some simple assumptions, and then perform ratio analysis on these future periods. And that's going to turn out to be very helpful for trying to estimate how an entity is going to perform in the future. Our second need goes to our DCF entity valuation methods, and especially NPV is what we've been working with mostly. And remember, the NPV of a project is equal to the sum of the present value of each cash flow, present value at first, then add them all up, and that's the NPV. So the problem, these are all cash flows in the future, except for maybe one that happens at t equals 0. So the issue has always been how to estimate those beautiful future cash flows. And we saw that with bonds or loans, it's relatively straightforward, right? We can use the contract, what the contract says the cash flows have to be, and provide some risk adjustment. And we looked at different models for providing risk adjustment, particularly the opportunity investment model. And if we're valuing a company or a company's project, it's much more difficult. And if we create pro forma projections of our financial statements, we can project what our free cash flows are going to be in the future. And remember, we looked at this future business here when we first looked at valuing entities. So we said that the free cash flow for an entity, this would be to shareholders in the year I, would be the net income in that year plus depreciation minus changes in working capital minus capital expenditures plus any changes in debt. And we looked at a very simple example where everything dropped out because we had a steady state entity except for net income. But usually, of course, companies are going to be growing, things are going to be changing. And to get all these quantities, we have to project forward our financial statements. Changes in working capital are going to come from projecting balance sheets. Changes in net income are going to come from projecting our income statements, and CapEx comes from our cash flow statement, et cetera, et cetera. And similarly, if we are valuing an entity to all stakeholders, we have something very similar going on. We have NOPAT okay, which is our net operating profit after tax, which is EBIT minus tax on EBIT, plus again, depreciation, changes in working capital, et cetera, et cetera. So to get all these numbers in the future, we're going to have to use pro forma in general, have to use pro forma financial statements and pull these quantities that we want out of those projected future financial statements. Okay, so with that in our pocket, what's our framework for creating pro forma? So as usual, let's say we're at t equals 0, right? And that'll correspond to end of period 0. And at this time, uh, under all circumstances, assets equals liabilities plus equity. We'll say that that's true for now. And then what we want to do is we want to project the financial statements forward by one period to t equal 1. That could be end of year 1 in the future, end of month 1 if we're doing monthly projections. So what are we going to do? We're going to use, and here I sound like an economist, but we're going to use quote unquote reasonable methods to estimate the value of all of our asset, liability, and equity accounts in the future, and we'll do it in such a way that at the end of period 1, assets at the end of that future period 1 are equal to liabilities plus equity at the end of that period. So I know I'm being crazy and squishy with this reasonable method. So let's think about that a little more. So what do I mean by reasonable methods? We're going to use reasonable methods to estimate account values. So in general, for us, this is not true for super sophisticates working at Blackstone or private equity firms doing special deals. But for general case basic stuff, good place to start is we will assume the future looks kind of sort of like the past. And what I mean here now is that we're not going to have any disruption in the industry. Uber is not going to come in and upend the taxi industry, for example. We're not going to have a major recession or depression, and the CEO of the company is not going to go crazy and say, all of a sudden, we're changing the whole company from making cars to making only toothbrushes or something crazy like that. So that's number one. And also, more reasonable methods we're going to use are to say that to compute any account's future value, wherever possible, we're going to use an accounting formula, okay? So that's a formula from accounting, okay, an accounting formula, or a CEO's directive. So here's an example of a formula. The interest in period 1, as it has been all semester, as hopefully you learned in accounting too, is going to be the debt at the beginning of the period times the interest rate. And a CEO's directive could be something like this. The CEO or the board of directors or the CFO could say, we are going to hold our debt level constant for the next 2 years. So that would just say debt in year 1 is equal to debt in year 0, etc. And then finally, for any account where we don't have a formula or a directive, we're going to assume this, that the value of account X divided by sales in period 1 are equal to, proportional to, the value of account X over sales in period 0. And this assumption is what's called a constant percent of sales assumption. And actually, as you're about to see, it's actually a really good assumption for balance sheet accounts as well as income statement accounts. So here's how we'd use it, for example. So accounts receivable has been running at about 10% of sales. So we're just going to assume that going forward, whatever the sales are, that accounts receivable is going to continue to be about 10% of that. Okay, so these are our reasonable methods. So no big disruptions. Future sort of looks like the past. Wherever we have a formula, an accounting formula, or a company directive, we'll use that to project forward. And wherever we don't, we're going to use this constant percent of sales assumption. So with that in our pocket, here's our little algorithm, or algorithm, as you know, is just a fancy word for recipe. So here's our little recipe for projecting forward. So we're going to need some historical balance sheets, income statements, and we're going to need depreciation, capex, and equity roll forward equations. I'll remind you of those. Those are something I'm sure you learned in financial accounting and might need a little reminder. And then next we'll make reasonable assumptions about the future. So something like the future will look like the past, except that we think we can grow sales by 10% instead of 8% or something like that. We're going to, in future period 1 here, we'll solve for account values using the historical financial statements, right? Because in general, the future will look like the past, and our reasonable methods. And then there might be some final values that we haven't gotten from a directive, or to say they're going to be proportional to sales. So to get any final leftover values, we use one of these two accounting equations to help us out, that assets equal liabilities plus equity at all times under all circumstances, and or equity beginning of period plus net income plus paid in capital minus dividends is equal to equity end of period. So that is a typo here, and let's correct that right now. And let me put a few stars here so I can correct that in the notes. Okay, and so we'll do that for our first future period, and then if we want to go into further future periods, we just do the same thing for period 2, and et cetera, et cetera, et cetera. So it's relatively straightforward. We're just going to have to keep our wits about us as we go ahead with this. So usually when we project, we're projecting, at least in part, to answer what I like to call a big question about one account. So let me show you some examples of what I mean by that. So the CFO could ask us, if we follow the company's planned strategy, how much cash will we have 2 years from now? That's a big question. Okay, so that would be the key for creating all the projections in this case. Another example of a big question is the board could say to the CFO, given our current strategy, what's the biggest dividend we can issue for the next 2 years? So the big question would be, what's the size of the dividend the company can issue for the next 2 years? So in all these cases, we're going to project all the other accounts. So we would project everything but cash here, we'd project everything but dividends here, and then we're going to use one of these two accounting equalities to help us solve for that one missing piece, that one big question piece, account value. All right, heads up that as we have already learned, seasonal companies we have to be careful about. When we did ratio analysis for seasonal companies, we had to do quarterly or even monthly comparisons year on year, and that's going to be true when we project forward as well. So if we have a seasonal company, we're going to have to project month by month or quarter by quarter, and non-seasonal companies we can project ahead year by year. So let's jump right into an example. This example is for Sahali snacks. Some of you may have encountered them. They're widely available at places like Whole Foods. They were available at Starbucks for a while until Starbucks came up with its own competing house brands. And Sahali designs and makes upscale nut-based snack products. It was co-founded by Josh Schroeder in 2003. He is a Columbia University MBA alumni. He is a friend of mine. We got our MBAs together, and I've worked with Josh and his company on various projects since then, and happily just started this from scratch and was able to sell it to Smuckers in 2017. So that's a really wonderful success story. Okay, so is Sahali snacks seasonal? So the answer is no. These snacks are used, they're bought by people year round. They're not a specialty thing like a fruit cake or a small thing of honey for some Jewish holidays, that type of thing. Sales may go up a little bit around holidays, but in general, people aren't buying these for gifts. They're buying them for themselves. So Sahali is not seasonal, and their financial statements bear that out. All right, so let's look at their situation at end of year 20x0. So for us, we're going to, as usual, call that now, although this was actually a little bit in the past when I was working with Sahali to actually do some analysis for them, that we're going to repeat here with simpler numbers and stuff like that. Okay, so what's the situation? So over the past several years, sales have been growing by about 10%. And you can see that here in the last year, they had about 91 million in sales, up to 100 million in the most recent year. So that puts the sales growth at 10%. And then if we look at everything else here, you see that I did a bunch of ratio analysis for them. Their ratios are relatively stable, so they've had good and growing profit margins. Their COGS margin very high. They're a very high variable cost firm, right? Because for every dollar of sales they make, they have to make another package of nuts. So very high variable cost firm. Okay, and their SGA costs fairly stable as we'd expect. They're not paying much in interest. They're not very levered. We got their tax rate. So their debt to cap, as measured by GAAP, about 20%, staying relatively stable, and their debt to EBIT is greater than 1, so that's good. And you can see here their fixed to variable cost ratio is very low. Again, makes sense for the type of company that they are. Their current ratio, they're selling pretty close to the wind. It's just about 1. So that's kind of interesting, but not the end of the world. So they have, Jamie Dimon would be really happy with these guys. Their EBIT, that's the earnings from operations available to pay interest divided by interest, is 8 or 9 times. So that's looking real good. And we can go through the rest of this stuff here. We've got their pre-tax interest rate, their tax rate, and their cash level. This is used by a lot of CFOs. We didn't focus on it too much in ratio analysis, but they use this as a measure of, do they have enough cash on hand? So cash level is cash plus short-term investment over sales, and Sahali's CFO felt like that number needed to be about 5% to make sure they had enough cash on hand at all times. So clearly you can see from this ratio analysis, everything's been pretty stable, jumping around a little bit, as of course it's going to do for any company, but really pretty stable, solid firm. All right, so here are their 2 most recent financial statements at the time. So again, the sales grew from about 91 million to 100 million, and the COGS went up pretty much proportionally to that. And again, I've simplified all of these things for us, but the numbers are representative of what was going on at the time. Depreciation is important for them. They do have a lot of equipment to cook these things, to mix them together, to package them. They have delivery trucks, they have warehouses, all that jazz. And so very straightforward income statements, and you can see here their profit has been increasing kind of in line with their sales. Okay, and their balance sheet relatively straightforward for a small industrial type company. They've got some accounts receivable, and these are growing with their sales, inventory growing with their sales. They've got some other current assets, and we're going to use the finance way of looking at PP. So we'll look at net PPE. That's growing too. The more sales they have, the more machines they have need for cooking these nuts, for mixing them, for packaging them, et cetera, et cetera. And they've got their accounts payable, accrued liabilities, that's unpaid salary and stuff like that. And they've got their other current liabilities. They do have some debt, not too much. They took out a little more debt in the past year, and we add up all their liabilities and we've got their equity there. So very straightforward balance sheets, and fairly nothing's jumping up and down in some weird, untoward way that we might not like or might not expect. The other 2 equations we're going to have to look at, the other 2 items are subsets of the cash flow statement. That's going to be the PPE roll forward equations for us, and subset of statement of owner's equity, which is going to be our equity roll forward equation. So the way that this one works, our equity roll forward, says that equity beginning of period plus net income minus dividends plus paid in capital, or minus paid in capital if there's a share buyback there, is equal to equity at the end of the period. This is a very fundamental financial accounting equation. It is important that you're familiar with this. So you can see in the most recent year, equity beginning of period was 76.85. Net income for the year, as we saw on the income statement here was 7.74, okay, and they paid no dividends in the year, so that's zero. And they did have a bit of a share buyback. They had an investor who wanted to leave. They bought her shares back, so that's fine. And then we just add all these up and we get to their equity at the end of the period for 20x0, and that's exactly what we see here. So this roll forward equation is going to be important for us doing projections. And then the second one that's important, as I said, is the PPE roll forward. And the way that this works is PPE net at the beginning of the period minus depreciation plus CapEx. That's additions to PPE, right? So depreciation is wearing out of PPE. So PPE net beginning minus how much it's worn out plus how much we've added is equal to PPE net end of period. So let's see if we can suss this out for the most recent year. So we've got here PPE beginning of period is always exactly the same as end of period for the prior period, okay? Their depreciation, we're going to see their weighted average life of all their PPE is about 10 years, so they're going to depreciate about 10% of that a year. We'll see that in a bit here. And they also, as they're growing, they target their PPE at the end of the year to be equal to about TTM sales. So we have the beginning here, we have the depreciation, which we'll talk about more. We have their target for where they want their net PPE to be at the end of the year, and that tells them how much CapEx they should be spending during the year to make that all work out. We'll look at the mechanics of this roll forward equation a little more as we go on. So now let's get into doing some real analysis about this. Okay, so just a little tip, if you've been following all the way through up to this point, congratulations, that's more than I could probably do in one sitting. So I'd suggest at this point, notice where the timer is, how far into this video we've gone, and pause the video at this point and go do something else. Take a walk, play some video games, read some wonderful financial information from The Economist or Barron's or something like that, listen to an episode of Bloomberg Surveillance, and then come on back and we'll continue. Okay, see you soon. All right, so back in action here. So let's think about now what was going on with Sahali at this time. They were at this time when I was working with them, they were clearly startup company, so they weren't issuing dividends. They were focused on growth and their exit strategy, selling themselves to something like Smucker's at the end of the day. But they're big enough now that the board of directors feels like they can start issuing dividends, and so the board has said that they want to start issuing dividends equal to 15% of net income for the next 2 years. So in terms of our ratio analysis, we would have called that a payout ratio of 15%. So that's all well and good, but the CFO needs to know if this is going to work. So this is really sort of put to as a question to the CFO. Can we do this? What are the consequences if we do this? Okay, so she is concerned, as she should be with any startup, is what's this going to do to their cash position? So her big question about this is, if we go ahead with this dividend policy, what's going to be the end of year cash balance for the next 2 years? So that's what we're going to solve for in our projections. She also wants to know, and the board, of course, wants to know how big will the dividends be, estimate, right? What's the projected estimate of how big those dividends will be, and her policy on the question of is the cash level going to be safe is, she says, and this is actually common for a lot of companies, she says that the cash level of the firm is safe if it's greater than or equal to 5% of 12 trailing month sales. So that's fairly common, and this is something you'll see, those of you who go on in finance, you'll see it in advanced finance courses and consulting and things like that. And she also would like to see a general ratio analysis for both years. So that's going to be exactly the same type of ratio analysis that we looked at the beginning of the Sahali example. Okay, so she has some views, and the firm has some policies for the next 2 years. So we're going to look at this situation with sales continuing to grow at 10%, dividends set at 15% of net income, payout ratio of 15%. Debt to cap has been most recently at 20%, and she would like to maintain that ratio so the firm doesn't get any more or less levered. Okay, and as I pointed out briefly before, they feel like they have enough net PPE. Their net PPE has to keep up with their sales because they need more ovens, they need more packaging equipment, they need more warehouse space, they need more trucks, that sort of thing as their sales grow to deliver more and more packages of nut-based snacks. So they feel, based on their experience, that their net PPE is keeping up if it at the end of the year is equal to about 100% of 12 trailing month sales. So that's going to be a target for PPE going forward. And the average depreciable life of all the depreciable assets of the firm is 10 years, which means that the depreciation in each year is going to be 10% of beginning of period net PPE. That's a lot of work she did to, the CFO did to get that number, but happily she did it, so we don't have to. So also, the board has said assume no stock issuances or further buybacks in this 2-year period. And since the leverage ratio is going to be the same, the pre-tax interest rate should stay the same, and they're not going to have any weird accounting changes, so their tax rate will remain the same as well. So now the CFO, given all this information, God help her, has chosen to ask us to help answer all of these questions. So let's go ahead and see if we can do that. So here's how it works. Let's start by looking at some historical formulas and percent sales ratios for Sahali's income statement. So I have the past 2 years here, okay, and I have how they relate to something like percent of sales or something else over in these 2 columns here. So let me show you how it's working here. So I've got sales for the year prior, sales for the most recent year, and the COGS in that year, and the COGS here in this year, okay? And then what I have here is this 68.8% is the COGS divided by sales ratio, okay? So let me just put in that down here. So this is 68.8% is equal to 62.5 over 90.91. And let's also put another star up here. This is one that you can check very quickly. The 68% is equal to 68 over 100. Okay, so these are percent. Okay, so these are percent of sales ratios for the year. So COGS was 68.8% of sales a year ago, and in the most recent year, it was 68% of sales. So, and one thing to note just now, I'll talk about this more, but it's remained relatively constant, even though sales went up by about 10%. So as a percent of sales, the cost of goods sold was about the same. Okay, so let's keep going. So depreciation, 8 million and change up to 9 million and change. How did that happen? That comes from our CapEx depreciation roll forward equation, which we looked at briefly and we'll look at again. Okay, and SDA is something we don't have a directive for, and we don't have an accounting equation for. So again, this is going to be percent of sales. Okay, and let's just put that in here. Okay, so 10.0% is equal to what here? We want to have our SDA of 10 divided by 100. Okay, so that 10%, 10 over 100, our SDA divided by sales in the year, so 10% of sales in year 0. All right, let's keep going. So EBIT is just a subtotal, as we know, and the interest is interest is always RD times BOP debt, and their RD we know is 7.5%. So in this case, this is a classic case where we do have an accounting formula. Wherever we have an accounting formula, we use that accounting formula. We will use it going forward, okay? And tax, as we know, we have a formula for that too. It's earnings before tax times the tax rate, which for Sahali is 33%. And that's everything. So we just come down and get our net income. So as sales are going up, net income's going up. That's a good thing. Okay, so when projecting forward, for the things on back here that are in gray, we have an equation to help us project forward, okay, for the stuff in gray. And everything else we're going to say is going to remain at a constant percent of sales. So in other words, in this year, if COGS was 68% of sales, when we project forward into year one, we're going to say that in year one, whatever the sales are, COGS is going to be 68% of that. So we're going to project forward based on year zero, not the average of year zero and year y minus one. And notice how this works pretty well, even with 10% sales growth. So 68.8 to 68, 10.2 to 10, even though sales grow by 10%, as a percent of sales, SG&A and COGS remain relatively constant. And that's very, very common. Okay, this is nothing I've fudged up for us. This happens as long as the future is looking kind of like the past. This holds up extremely well. Okay, so let's think about a little bit about the items that we are going to project as percent of sales. So anything that we don't have an accounting formula for, a CFO directive, what we're going to do is we'll say the account value in year one, that's our first projected year. It's going to be our estimated sales in year one times the accounts percent of year zero sales. So here is, for example, our COGS percent of year zero sales. That's 68%. Okay, so we would say if we're projecting into year one that the COGS in year one is going to be whatever the sales in year one is times that 68%. Okay, and again, that 68% comes from the year 0% of sales. Let me put back here, this might help us a little bit. So formula or percent of sales, just to make it clear what's going on in these two columns. Okay, so I'm saying we should project these things forward based on the year zero sales. So I know some of you inquiring minds out there might be thinking, well, wouldn't it be better maybe to take the average of the past 2 years percent of sales? And the answer is yes, absolutely. In this case, it would. It might be even better to go back 3 years or 4 years and take the average. But I'm doing it based just on Y0 to keep it simpler for you all. So there are fewer mistakes, fewer work for you, less work for you and all that jazz. So we're generally going to project ahead to year one, year two, year three, based on what happened in year zero. And that really is just for pedagogic purposes to minimize errors and things like that. Okay, so yes. All right, we're just using Y0 only for convenience. There are cases when using just last year's percents would be best, and that would be when industry, company, etc. was disrupted. Okay, if we've had a big change in the industry or the company has moved into new markets or something like that, the old company before the disruption happened, all of that stuff just doesn't count. So we just want the most recent year, which represents the company's current state going forward. Okay, also one other thing that's interesting here is we said that SG&A projects as percent of sales here. So here's our little SG&A. We're going to project it forward as percent of sales. And really, that's sort of at odds with our notion that SGA is a fixed cost, right? All right, so this is not really a great assumption. And as you know, in our models, we have a lot of bad assumptions. Does this conflict with our prior ratio analysis assumptions? Yes, see above. Right, that it is in fact a fixed cost, okay? And it's okay to have this problem. Why? So SGA, relatively small, okay, expense, and we're not projecting many years forward, okay? And and finally, especially if we're consultants doing this work, this would allow us to make improvements in the model as a phase two. So we report to the CFO all this great stuff, and she says, "Oh, that's really great." And we say, however, we can refine this for you and do better. For example, we can do a good study of where your SGA is going to go and model that in a more sophisticated way than just assuming it's going to grow with sales, which is probably a bad assumption, and et cetera, et cetera. So then we get the phase two contract and we get another $100,000 and we're very happy as consultants. Okay, so let's move on. Okay, so now let's go back and review some of the income statement items that we are going to project based on an accounting formula or a CFO's directive. Those were the things shown in gray back here, here we go, okay, shown in gray. So let's just go through them, make sure we understand them all, okay. So depreciation is always, it really has nothing to do with sales. It's always some percent of PPE cost. So we're going to get our depreciation from our PPE depreciation CapEx roll forward equation. All right, so we always want to do that with depreciation. And we'll look at that roll forward equation more carefully in a minute. I'm skipping all the gray pages as usual. Okay, next up, we do have an accounting formula for interest expense. So we're always going to project forward using that. Interest expense is going to be debt at the beginning of the period times that RD interest rate, which is 7.5% for Sahali. And that you want to get that 7.5% if you don't have it already, including all the debt, all the loans, all the bonds, long-term, short-term, okay? And then next up is income tax expense. We do have an accounting formula for that. Income tax is always earnings before tax times the tax rate, which for Sahali is 33%. And then next up is dividends. Dividends in general are always going to be set by the policy of the board of directors. And they may say they want dividends as a percent of sales, percent of net income, or anything else that they say, okay? And in this case, the board said that they wanted a particular payout ratio. They wanted the payout ratio to be 15%. That translates to 15% of net income. And they want to try that for the next 2 years and see what happens. And then another thing to think about is paid in capital. And the board and the CFO have said for the next 2 years, assume there's no share issuance and no buybacks. But in general, definitely this is not going to project as a percent of sales because it's a policy set by the board of directors. So that's definitely not going to project as a percent of sales in general. Okay, so now let's do the same sort of thing for Sahali's balance sheets here. Okay, so what I've got are the past 2 years balance sheets. And over here for each of the 2 years, I've either got percent of sales or formula. So let me put that in here of sales or formula. Okay, so no special formula for accounts receivable, no special formula for inventory, no special formula for other current assets. So I just get the percent of sales for each of these, and 20x0 is easier for me to point out to you, because the sales in that year I've rounded off to an even 100 million. Okay, so the 25% of sales here is equal to 25 over 100, and that's equal to AR at EOP Y0 divided by sales in Y0. All right, so that's how, this is an example, but that's how I've gotten all of these percent of sales. And same thing here, when the sales in this year were about 90.1 million. Okay, so the cash level I'm not going to worry about, because this is her big question. We're going to be solving for that going forward, so I don't care about that. And for PPE, that's part of our PPE roll forward equation. Accounts payable, no special accounting equation, no directive on accounts payable or accrued liabilities or other current assets. So I have my percent of sales for these guys here. And the debt here, we definitely do have something for debt. The company policy is to keep that D over D plus E constant. That's what they want to do going forward. So that'll be the company policy for that. And for equity, we're going to use our equity roll forward equation. So equity EOP equals E BOP plus net income plus PIC, which for us is going to be, as we know, 0 minus div. So this is pretty much how we're going to project things out on the balance sheet. Okay. And yeah, things to note here. So most of the things where we have no formula available, where we're measuring them going forward as percent of sales, you can see there it's not perfect, but even though sales have grown 10% in the past couple of years, these ratios are pretty constant. And what a lot of folks like Warren Buffett, value investors, would say is that this is the balance sheet that is needed to support a given level of sales. So the balance sheet looks like this. You need a balance sheet with AR equal to 25% of sales, inventory equal to 25% of sales to support any given level of sales. Okay, so yep, anything we don't have a directive for on the balance sheet, we're going to project these forward as a constant percent of Y0 sales too. Okay. And the thing shown with gray on the right, we do have formulas or CFO policies for, and cash levels are, that's the big question, right? Cash level is the big question from the CFO. So we're not going to worry about the history of that. Okay, so let's think a little bit about the things we are projecting as percent of sales. Okay, the things that we're projecting as percent of sales, as we've seen before, we're going to say account value on the balance sheet for year one, which is always end of year one. It's going to be estimated sales in year one times that accounts percent of year zero sales. And I've done this example for us on the previous page. So that would work out to AR at well, this was for history, so I'm not going to put it in, but going forward, the accounts receivable at end of year one will be our estimated sales in year one times 25%. And again, where did we get that 25% from? We got it right here. It was accounts receivable was 25% of sales in the most recent year, and we're assuming it's going to be 25% of sales in the next year, year one, that we're projecting for. Okay, so let's just think about things that we have a formula for. Once again, just sort of beat this together. So cash, again, we're going to solve for that, so not to worry. But in general, if we weren't solving for cash, it would be set probably at some percent of TTM sales. PPE is part of our PPE CapEx depreciation roll forward. So we have our equation for that, our net PPE, we'll use that. And for debt, we have our company policy here that debt to cap is equal to 20%. And if you do a little bit of algebra on this, you can confirm this for yourself, that the debt in every year going forward is going to be 20% of the equity divided by 80%. So that's our formula for debt. And how are we going to get equity, we always have two things in accounting that help us with equity. One is our roll forward, equity end of period equals beginning of period plus net income plus paid in capital minus dividends. And we also know that equity at all times under all circumstances equals assets minus liabilities, okay? And we're going to use this. We will use 22J to help us in this case. Okay, that's our equity roll forward equation that we talked about. And this is just something that you should know. Sahali has no goodwill, but it's a good thing to know about. And remember, goodwill is what an entity pays for a company that it purchases over market value of equity. And GAAP has a couple rules now about how to handle this, but the one that we're most interested in, the most common one, is to say that goodwill is constant forever unless the company has a reason to believe it's been impaired. And that's going to be our assumption, that if we see goodwill on a balance sheet, we're going to say it's constant unless we're told that it's compromised. All right, so let's look at our historical roll forward equations now. Again, we have equity beginning of period plus net income minus dividends plus paid in capital equals equity end of period. So you can see equity end of period for the most recently reported year was equal to 80, and that's equal to 76.85. The equity at the beginning of the period plus the net income of 7.74, okay, minus 0. Remember, they haven't been issuing dividends, okay, and minus 4.58. That, again, remember they had a little share buyback. They had an investor who wanted to leave. They bought some shares back. That was fine. So that's what we've got there. Okay. Yeah, that looks good. Okay, and now the other thing that we're going to need is part of the taken from the cash flow statement and other stuff, which gives us our PPE roll forward equation. PPE net beginning of period minus the amount of wear plus the amount we've added to PPE is PPE net end of period. So you can see my end of period for a year ago becomes my beginning of period for the most recent year. My depreciation, remember 10-year average life of all their PPE, so it'll be 10% of beginning of year net PPE, and their target for PPE at the end of the year to make sure they have enough to keep up with all the new machines they need for baking and mixing and packaging and all that stuff is they want at the end of the year their net PPE to be equal to 100% of TTM sales. So in this case with Sahali, they know this, they know where they want to be, they know what depreciation is, and they solve for the amount of CapEx they have to spend to make this true, to hit their target for net PPE at the end of the year. So they can solve for their CapEx, and they're going to do that using the roll forward equation. So the net PPE at the beginning of the year, let me just put the whole thing here, 18.18 is equal to our 100 minus 90.91 and plus 9.09. And that gives us our 18.18, solving that for CapEx. Okay, now we're ready to set up our projections.